Hey guys, check it out. I want to show you what I do when a trade goes against me and what I do when the trade starts to lose. All right, so this is the chart I'm showing you here is Starbucks. So let me zoom in real quick. This is SBUX, that's Starbucks. And what I did was on June 7th, you can see down there 6/7, June 7th, I put on a naked put. So what I did was I sold a 70 strike naked put, and the stock was trading right around $77, $78 or so. And at the time, it had about an 80 to 85% chance of winning. And let me show you what I ended up doing, because as you can see, a couple days later here, it went down here to about 70. Okay, almost put my strike in the money. It didn't actually go in the money, but I was losing on the trade because the volatility was going up and it was coming closer to my strike, which means that if I wanted to get out of it, I would have to pay a lot more money than what I was paid to get into the trade in the first place. So let me switch over here to my other platform and show you what I did. All right, so this is Starbucks. It started out as a naked put, remember, but I turned it into a strangle. So let's see. So the first one on June 7th right here, you see I sold I sold to open two naked puts, and I received $162, or basically 81 cents for each one. All right. And as it came down, what I ended up doing was I sold an 80 strike call. So two of those. And you can see here, I did that on the 17th. And I did one for 45-cent credit and one for 50-cent credit. Or remember, for each contract, you got to multiply your cents times 100. So 45 cents equals $45 and 50 cents equals $50. Hopefully that makes sense. A few days later, the market came back up a little bit, and you see on June 24th right there, I went ahead and I closed out on the 24th the call and the put, and I rolled that out to August. Now, why did I do that on the 24th? I did that because I was still underwater on the trade. I was still losing, and it was 21 days before expiration, or right around there. And my mechanics tell me that that's the optimal time to actually roll a trade if you're not winning. So that's what we did. Was we closed out here. You could see June 24th. I bought back the two 70 puts, and I also bought back the two calls right there. And so the calls was $191 loss, and the puts I think it was $68 profit, something like that. And all I did was I rolled it out. So what does that mean? All that means is I am prolonging the trade. I'm moving it out in time, giving myself more time to be correct. So technically, you see a loss here and you see a small gain. That's not completely accurate, because since I rolled it out in time, I also received a credit for doing so. So you see here for the call, I sold to open, I received $3.06 per contract, or $612. And then for the put, I received $1.80 per contract, or $360 total, if that makes sense. So then, let's see, today, I was able, on July 14th, as you can see here, I was able to close the entire trade out. And because I was losing, I consider, when I start to lose a trade, what I do is I look to scratch or make a small profit. And I continue to roll out the trades in time until I receive enough credit where I can close for a small profit or a scratch. And that's exactly what I did today, July 14th. I closed it for $58.38. That's not a lot of money, but it covered my commissions and everything. And because I was losing, I was able to turn a losing trade into a small winner, or what I would consider a scratch. I hope that makes sense. If it doesn't, give me a comment below and let me know, and I'll try to make a better video and explain a little bit more in detail. And what you need to do is follow me so you can see exactly what I'm trading and how you can profit from losing trades.